All right, Luke, let's bring you back in. And I want to talk about motives and investing motives around ESG. So, investor interest in ESG has clearly increased in recent times. What do you expect will be the trends for ESG investing and returns going forward?
Sure. Let me start with the ESG returns because this is an area where I've been doing a lot of research lately. I'll tell you what I've learned recently about ESG returns, and then we'll talk about kind of what that means for boards and what that means for executives. So with my co-authors, I've been studying the past trends in ESG returns, and we've been asking what do those past trends imply about the future performance of ESG investing strategies. Basically, the punchline of our research is that ESG investing strategies have performed well in the past, but we should not expect them to perform well in the future. And this relates to what you brought up about the motives of ESG investors. When you ask investors why they do ESG investing, we have various surveys in which we do that. And what investors typically say is one of their top two reasons for doing ESG investing is to get higher returns. And when you ask asset managers, should we expect high returns from ESG strategies? They also say, yes, we expect high returns from ESG strategies. My research says the opposite. We should not expect high returns from ESG strategies. And we have two reasons for saying that. The first is just appealing to economic logic. We've got a lot of ESG investors out there. They like holding, I'll call them green stocks, ESG-friendly stocks. That demand makes those green stocks expensive today. They have high prices today. So that means those same stocks, they have lower expected future returns. Their price is already high. It just doesn't have that much room to grow in the future. So that's the first reason we say we should not expect high returns from ESG. The second reason we say that is just by looking at the data. We look at the E part of ESG. We look at environment. And we just look at a simple investing strategy where you just buy the environmentally friendly stocks and you short the environmentally unfriendly stocks. That, I'll call it a green strategy. That strategy has performed incredibly well over the last 8 years. Should that outperformance lead us to expect more outperformance going forward? Well, we find the answer is no. We find that those past returns were unexpected. They were due to unanticipated increases in concern about climate change. So first thing we do is we show that, to none of our surprises, I hope, we've become a lot more concerned about climate change over the last 8 years. And then next we show that bad news about the climate, it tends to be good news for the returns of green stocks. And then we do kind of a what if analysis. We say, what if the last 8 years had been different? What if we had not seen these huge increases in concern about climate change? We can do that with like a very simple statistical analysis. And what we find is that the outperformance of these green stocks disappears if there had been none of these increases in concern about climate change. So that's why we say this outperformance was unexpected. So, how does this affect boards? It affects boards in two ways. So, the first thing our research says is that if a company can just make itself a little greener, more ESG friendly, that's going to help the company's stock price. Okay. So all companies, green companies, not green companies, all companies have this incentive to become a little bit greener. And the second way it affects boards is through the cost of capital. What our research says is that this rise of ESG investing has changed companies' cost of capital. It's made capital cheaper for green companies. It's made capital more expensive for non-green companies. So if you're on the board of directors for, let's say, a solar energy company, you should be saying, capital has become a lot cheaper. I should go raise some of this cheap capital, and I should use that to build more solar farms. If instead you're on the board of let's say a non-green firm, like a coal company, well, you should be saying capital has become a lot more expensive for us because we're not ESG friendly. And maybe we shouldn't be out raising expensive capital. Maybe we shouldn't be digging more coal mines. Um, so I think the end result here is actually great news for society and for the environment, because we should be seeing all companies becoming greener simply out of a desire to increase their share price. And we should be seeing capital reallocated away from non-green firms and toward green firms. We should see less coal mines. We should be seeing more solar farms, thanks to the rise of ESG investing.
How exactly can ESG investors create positive social impact? And are there specific steps that they can take to be more influential in this regard?
Sure. It's a great question. How can ESG investors have actual impact? I can think of three ways, at least three ways. The first is through engagement. Okay. The idea is you buy a stake in a company and you directly engage with the management team to achieve whatever your ESG goals happen to be. The prime example of that, again, would be engine number one, buying a stake in Exxon and advocating for climate policy. So that's one, engagement. I think that the second channel would be by inducing all companies to become greener. Um, the evidence suggests that you can make your stock price higher by making your company greener, and that's true if you're already pretty green. It's even true if you're the Exxons of the world. So basically, ESG investing can have impact by creating this incentive for every company to become even more ESG friendly. It's a case where doing the right thing for ESG happens to also be the right thing for making your stock price higher. So that's number two, every company becoming greener. The third way would be ESG investors can have impact by essentially causing capital to be reallocated in our company. And it goes back to what I was saying about cost of capital. The rise of ESG investing has changed companies' cost of capital. It's made capital cheaper for ESG friendly companies and vice versa for the unfriendly companies. And again, this means that you're going to have impact by inducing the ESG friendly companies to expand their operations. You're also going to have impact by inducing the ESG unfriendly companies to possibly shrink their operations. So hopefully the end outcome is, we see, for example, more solar farms and fewer coal mines, like I said earlier.
Thanks. I actually have a quick follow-up on that. We're talking about the role of the investor, but is there a role of the consumer in all of this? For example, part of the challenge is consumers are still utilizing products that are not ESG friendly, if you will. And so how do investors think about the demand from the consumer side for these companies' products while also recognizing that there's an opportunity and a need to sort of shift towards more ESG promotion related activities?
Sure. Is that for me as well?
Yeah. Sorry, Luke. Yes.
Yeah, sure. Yeah, absolutely. If you're sitting on a board, you need to be very tuned in to what customers want today and what customers are going to want in 2 years, in 4 years, and 10 years. And I do think we have seen these big shifts in customer demand based on how ESG friendly is the product or the service that you're selling. So hopefully companies are seeing the writing on the wall, whether it's good news or bad news. If you see this as ESG as being good news for customer demand, well, hopefully you're scaling up your operations. Whereas if you see, I don't know, as an example, you see, look, people aren't going to be burning a lot of coal in 20 years. Well, hopefully you're planning for that today and already starting to scale down. So absolutely, ESG investors can have impact, but I think customers also have huge impact on which companies are big, which companies are small in our economy.
What mechanisms could encourage the migration of investments away from non-green companies? For example, should ESG investments carry tax benefits?
Oh, that's interesting. Should they carry tax benefits? Um, that's probably not the first lever. That's not the first lever I would go to. The lever I would go to first is just let the investors vote with their dollars. And to the extent that they care about E, or to the extent that they care about S or G, let them direct their portfolio dollars toward the companies that are aligned with their values. That alone, voting with your dollars, tilting your portfolio one direction or another, that's going to change companies' market prices. And that's going to therefore change companies' cost of capital. And that is what's going to help reallocate our society's resources toward hopefully more ESG friendly outcomes. I think we should also say that ESG investors alone are not going to save the world, right? It's kind of an obvious thing to say, right? But we need a lot more than ESG investors. We also need smart rules. We need smart laws on the books. For example, I'm like almost every other economist out there. I think we need a carbon tax, right? I don't think ESG investors alone are going to solve the climate change problem. We also need smart public policy. So I think we need a constellation of solutions. ESG investors voting with their dollars is a big part of it, but we also need smart laws on the book.